First up, every fund manager you talk to has a different approach to stock selection. The question is whether his or her selection framework gives the edge in performance. Sarasin and partners employ what they refer to as a thematic approach to investing. Guy Monson is the Chief Investment Officer at Sarasin and Partners. He joins us from our London studios. Welcome, Guy. Good to speak to you. Would you agree with my summation there that it's really about a framework, and in your view, it would be a tool in which to select the outperforming stocks?
Yes, I think that's right, and I've been responsible for thematic investment style right back to '96. We look after about $20 billion here. And we look a little bit like a company or global corporation might do itself. We look across industries, we look across borders, and we look for strong multi-year themes which we think will contribute to above average earnings per share growth and a potential re-rating in the underlying stock.
So the latest themes that you've identified, to me, that there's a commonality to them. It's about change and being nimble enough. And the one is disruption and innovation, and the other is franchise power. If you could elaborate on what those are and what they mean.
Well, I think disruption and innovation is a particularly exciting theme in today's global economy. It tends to become powerful when companies have done very well for a very long time. Margins are large, cash balances are high. If anything, management is a little bit complacent because inbuilt brand and things has locked customers in. And that's exactly the moment when you unlock disruptive technologies that can change the entire approach to a market. I think the way that Netflix has done so for media distribution, the way that Tesla is doing so potentially for the electric car, and many more practical examples, Google interrupting a whole lot of underlying markets. Those sort of rapid gains in market share, potentially enormous re-ratings, which look crazy at first sight to investors looking over the positions. If you have your thematic glasses on, those disruptive innovation stories jump out at you.
Guy, you've also, those are the two new themes, I guess the two new buckets, if you could call it that you've identified at Sarasin and Partners for investments. I just wanted you to elaborate for the benefit of our audience who are not too familiar with thematic investing, because we don't really have too many practitioners, if at all any, in South Africa. Just what it means and some of the other buckets that you look at in terms of studying change and how those will affect business models around the world.
Our second bucket is what we call franchise power. These are really dominant pricing opportunities supported by pricing power, reputation, brand, that have an ability to grow in a global market, particularly where the middle class in the emerging world is growing so fast and dietary change is coming through so fast, that have an ability to sustain margins over a prolonged period. I mean, they're familiar names. They're Coca-Cola, they're Nestle, they're Novartis, they're Sanofi, they're Yum brands. We were particularly proud to be very large holders of Heinz when Mr. Buffett took the stock out for exactly the reasons that we would identify. Superior cash flow typically, progressive dividend policy, very consistent and regular management. It sounds an obvious story, but these, I think, are real repositories for safe, almost bond-like investment, and we think they'll trigger a tremendous re-rating as the markets move ahead in this low interest rate environment. We're of course interested in corporate restructuring, and that's primarily targeted at the moment at financials. We're looking at some staggering share buybacks and dividend flows coming out of very vanilla US banks as they re-enter, if you like, a normal financial world. If you look at the share buybacks and dividend flow that we're expecting out of US banks, we're expecting share buybacks of about 26 billion this year and 14 billion of dividend flows. So that would be the JP Morgans and the Citis, and increasingly some of the European banks being drawn back into that network. Potentially the good numbers out of UBS, the improving numbers out of Lloyd's. So this is classic corporate restructuring turnarounds, cross-border, concentrated primarily in the financial services industry. So that's the sort of global buckets that we're tipping stocks into, and we're not too worried about the industry or the country in which they land.
How worried are you, Guy, about pricing, about valuation? So, because some of these themes that you've described, I would imagine that those would be pretty expensive stocks, and including some of the examples you've listed. So if you're going to go for a stock that has enormous pricing power, you clearly won't be the first to have identified that and to have bought.
That's what you'd think, isn't it? But it doesn't actually turn out that way in practice. Our portfolio is actually operating at a mild valuation discount, trading at about 11.5 to 12.5 times prospective earnings. Many of our bank and financial stocks are trading below book. And in terms of free cash flow, many of the names that we have are in double digits. And many of them will at future dates be almost debt-free. Many of the bank names in terms of price to book are trading at a fraction of what they were pre-Lehman's. So the interesting thing is you're not paying a particular valuation premium to buy the best. So you'll find our approach at the moment, interestingly, concentrated largely in the Western markets, although much of the growth is coming out of the emerging world. Now that will change, the approach isn't biased away from the emerging world at all, but actually we're capturing a lot of the fund flows and a lot of the intellectual property in the West rather than the New World. But interestingly, with a few exceptions, and I've certainly named a few, but in general there isn't a valuation premium to be paid.
Guy, just coming back to the disruptive technologies bucket, I'm intrigued. This is still a very new concept and idea for me, thematic investing. Where would you say, with specific relation to that disruptive technologies, how your analysis and understanding and conviction is developed through analysis versus perhaps a conventional money manager? Are there any big differences that you can point to in the way you go about searching for these companies and evaluating them?
It's a very good question. We certainly have a disproportionate number of engineers and scientists on our investment team. We typically make wide use of a lot of the alternative investment community, meaning direct business experts, meaning going direct to consultants, meaning using even a management consultant to oversee a lot of our idea gathering. So we tend not to operate so tightly in the classic brokerage-driven research world. We tend to go for industry and product specialists, a lot of it science-based. These themes tend to be, three, typically 4 years in duration. Interestingly, not 5 or 10 years in duration, because a lot of people catch up on the same stories and valuations start to rise. Interestingly, disruptive innovation is normally particularly profitable after a long period of extremely strong earnings growth by technology leaders. That's exactly when the window opens. And an Apple, say, or many of the cable firms, for example, are reluctant, in Netflix case, to offer discounts to match a new incumbent in the formats that they're developing. So it's thinking out of the box, it's taking a very scientific and fundamental approach, and it's trying to think like the companies think, rather than someone who is necessarily obsessed with shorter market performance might think.
How difficult is it, Guy, from the outside to identify such a disruptive and innovative business? On the one hand, I'd imagine that you have these businesses that seem exciting on the outside, but they seem not to deliver. But yet this last point that you just made, that it's almost, there's such a long lead indicator of outperformance that it's almost a safe choice.
Yes, the challenge is often that sometimes a disruption innovation is in a mid-sized company with a very pure approach. Sometimes it's embedded in a conglomerate. I mean, we certainly think that the genomic revolution, which is really going to hugely change the way in which medicine is delivered, and look at some of the progress, for example, on hepatitis C, etc., from some of the genomic modelling. I think you're going to find that really embedded primarily in some of the big players, Amgen and particularly Hoffmann La Roche. You move to a very simple area that as emerging world middle incomes get larger, we get more health demand. A lot of that concentrated in eyes and ears. We're very interested in the disruptive technologies that Essilor, the French spectacle and glasses companies, have in some of the new technologies that are emerging in that field. So they often come in relatively mundane areas, and it's often a long time after the industry picks up the trend that the stock market picks up the trend. So funnily enough, you have quite protracted entry points.
Guy, I just wanted to get to, obviously this analysis leads us to the conclusion you've got a very different view on how the world's being shaped and some of the change that's taking place. Perhaps you could just identify, before you go, 3 macro trends that you think are going to shape and have the most influence on business models going forward.
Yes, I think the biggest one is the transition from repression to reflation. The Western central banks, supported ably by governments, are absolutely determined to repress yields in a whole number of assets. And that means that global equities, and in fact any asset class that can provide inflation plus cash flows, are going to be re-rated quite aggressively, just as long-dated bonds were a few years ago and credit was last year. So I think the visible hand of policy, the repression agenda of the central banks is key. Secondly, I think we will go local. I think a lot of the outsourcing trends that really dominated the 2000s, particularly in the US, will be reversed, and a lot of production will be repatriated locally to meet government targets of jobs and job creation and acknowledge the fact that costs in the emerging world are rising. So I think localization is a powerful agenda. Finally, of course, and it's a less ethically attractive area, but defense challenges are rising around the world, particularly in Asia. And I think a more muscular Chinese defense policy and a more determined Japanese policy and some of the issues we're seeing in the Koreas, etc., will mean an acceleration in defense budgets around the world. And that's probably a rewiring, really, of defense and security for what's essentially a multipolar world. So repression to reflation, localization, a change of the defense agenda are 3 big macro and policy agendas which I'm weaving into my portfolio.